The wealthiest people in this country don't pay tax the way you do. They don't sell their assets. They don't take big salaries. And when they die, the tax bill on millions of pounds of growth just disappears. It's not a conspiracy theory. That's the UK tax code. And the strategy has a name: buy, borrow, die. In the next 10 minutes, I'm going to walk you through exactly how it works, why it works differently in the UK than in America. And the one mistake that costs UK company directors 5.75% the moment they get it wrong. Step one, buy. This is the simple part. You buy assets that go up in value over time: shares, property, a business, a portfolio. Doesn't matter what, as long as it appreciates. Now here's the thing most people miss. You don't pay capital gains tax when an asset goes up in value. You only pay it when you sell. So if you buy shares for £100,000 and they grow to 500,000, that £400,000 gain just sitting there. No tax, not a penny, as long as you don't sell. And this works for company directors too. If you started your company with £100 in share capital and that company is now worth 500,000, a million, 2 million, you've got a massive gain sitting there, but you haven't sold, so there's no tax. Pay attention to this part. The whole strategy depends on this one principle. Don't sell the asset, ever. Step two, borrow. So you've got assets worth a fortune, but you need cash. Normal people sell something, right? Cash in their shares, sell a property, sell part of the business. The problem, the moment you sell, capital gains tax kicks in. 24% for high rate taxpayers. That's a massive hit. On a £400,000 gain, that's £96,000 gone to HMRC. But what if you don't sell? What if instead you borrow against the asset? You go to a bank, you say, I've got a portfolio worth £500,000, lend me £250,000 against it. The bank says fine. They take the portfolio as security. You get £250,000 in cash. And here's the critical bit. The £250,000 is not income. It's a loan. HMRC can't touch it. No income tax, no capital gains tax, no national insurance, nothing. This is called a Lombard loan or securities-backed lending. Private banks like Coutts, Barclays Wealth, Brown Shipley, they all offer it. Typical loan to value is 50 to 70% of your portfolio. Interest rates are competitive. Dell did this. She bought a £50 million house with a mortgage, despite having the cash to buy it outright, because selling assets to raise 50 million would have triggered millions in capital gains tax. The mortgage costs a few percent a year in interest. Now, this is where it falls apart. If you're a UK company director and you think, right, I'll just borrow from my own company instead of a bank, stop. If your company lends you money and that loan is still outstanding 9 months after your company's year end, HMRC charges your company 35.75% of the loan under Section 455 of the Corporation Tax Act. 35.75%. That went up in April 2026. It's linked to the dividend upper rate, which also went up. So on a loan of £100,000 from your company, that's £35,750 your company has to pay HMRC. The whole point of buy, borrow, die is that you borrow from a bank, not from yourself. The borrow step only works if the lender is external. This is the part nobody checks until it is too late. Step 3, die. I know, not the cheerful part, but this is where the real tax saving happens. When you die in the UK, something extraordinary happens to your assets. All of the capital gains that built up during your lifetime are wiped, gone. The tax code calls it a CGT uplift on death. Your heirs inherit your assets at their market value on the day you died. Not what you paid for them, not what your base cost was. Market value. So that company you started for £100, now worth 2 million. If you'd sold it during your lifetime, the CGT bill at 24% would be £479,280. But if you die holding those shares, the gain is wiped. Your children inherit at 2 million. Zero capital gains tax, which is extraordinary when you read the legislation, but that's only half the picture, because there's still inheritance tax. In the UK, inheritance tax is 40% on everything above £325,000. That's the nil rate band, and it's been frozen since 2009, 17 years. It's frozen until at least 2031. So your £2 million estate minus 325,000 nil rate band leaves 1.675 million exposed to IHT at 40%. That's £670,000. This is where the borrow step comes back in. Remember, you borrowed against your assets. You've got outstanding debt, and debt reduces your estate for inheritance tax purposes. If you've got 2 million in assets and 1.2 million in borrowing, your net estate is 800,000 minus the nil rate band. That's 475,000 exposed. IHT at 40%, 190,000. Compare that to 670,000 without the borrowing. That's a saving of £480,000. Right, so far this sounds too good to be true, and for a lot of people, it is, because there are traps that nobody on YouTube is telling you about. Trap 1. HMRC anti-avoidance. Section 175A of the Inheritance Tax Act says HMRC can deny the deduction for borrowing if the debt wasn't incurred for genuine commercial purposes. The borrowing has to be real and it has to have a commercial reason. Trap 2. The CGT uplift might not last. The Institute for Fiscal Studies has recommended abolishing it. If a future government treats death as a disposal event, the entire amended part of this strategy collapses. That's a political risk you need to know about. Trap 3. Interest rates. This strategy assumes your assets grow faster than the cost of borrowing. If you're paying 5% interest and your portfolio grows at 7%, the spread works. If rates go up and growth slows down, you're destroying value. And trap 4, margin calls. If you've borrowed against a share portfolio and the market drops, the bank demands more security or starts selling your assets. A forced sale triggers capital gains tax, which is the exact thing this strategy was designed to avoid. So what does the correct structure look like? If you're running a single limited company, the principle still applies. You build value. You don't strip everything out as dividends. You hold the shares. If you're at a higher level, multiple companies, significant assets, the full strategy works through a holding company. Profits flow from the trading company to the holding company as dividends, tax-free between UK companies. The holding company builds a portfolio. You borrow against that portfolio personally. On death, the shares in the holding company receive the CGT uplift. Your personal borrowing reduces the net estate. Your heirs inherit the holding company at probate value. They can sell assets inside it to repay the loan. With no CGT on the historic gains, that's buy, borrow, die done properly. So that's what you need to know. 3 steps. Buy assets, borrow against them, and let the CGE uplift do the work on death. If you want to work out your own strategy, there's a free tax game plan ebook in the description. Make sure to subscribe, and I'll see you in the next video.